demand and supply. But I'd just like to make one point very clear. In the case of wheat, corn, soybeans, coffee, cocoa, demand and supply is very important because essentially these are perishable commodities, and every year the supply is essentially taken up. And so whether the demand is strong, and usually these commodities, they fluctuate according to supplies. If there is a bad crop, then prices tend to go up because the demand is relatively steady but rising in the long run. In the case of gold, silver, and probably to a lesser extent in the case of platinum, there is huge inventories of gold in the hands of investors. So let's say we have in the world, I don't know, 150,000 tons of gold, of existing gold supplies, of existing gold, and the supply is, I think, 2,000 tons a year or something like this. And so whether the supply is large or small, in comparison to the existing gold holdings, it's not meaningful. So the demand-supply equation in the case of silver and gold, I suppose in a very long run it has an impact, but not on a yearly basis. What impacts the gold price and the silver price, platinum, to some extent also palladium, is what investors want to do. Are they accumulating or are they selling? Plus, some of these metals may be manipulated. Who knows?
Let me lead you then from there to the folks that dig the stuff out of the ground. There has been a significant rally over the last 90 days in the mining shares. So we received several thoughts or questions wondering about your thoughts on that sector going forward.
Well, as you know, the mining sector has been a disaster compared to the S&P since 2011. And starting the fourth quarter of last year, the shares began to bottom out and started to appreciate not just against the S&P, but also on their own. In other words, say you look at the various gold ETFs, they're up between 50 and 60 and close to 70% from the lows. So they have begun to outperform the S&P. I think they are overbought in the near term. But when I look at the whole investment community in the world, and I travel extensively to Japan and to Europe and the Middle East and everywhere, hardly anybody really owns gold and precious metal share. So my sense is that once the investment community, that is by and large not very smart, the professional money managers, but once these professional money managers understand that the money printing is likely to continue, I don't see it stopping. I don't believe there is a currency war. I believe the central banks coordinate their monetary policies. And we know that Yellen talks regularly to Draghi and so forth. And in this environment, I think eventually even the fund managers will realize that it may be a good idea to keep maybe 5 to 10% of their assets in precious metals. And by then, obviously, precious metals will be on fire as well as the shares of the underlying companies that produce precious metals. My sense is that we've seen a low in precious metals prices. We had a very powerful rally. Very few people actually believe in the rally. There is probably a correction occurring now or about to happen. And then we'll go, in my view, significantly higher.
Sounds good to me. And I think most folks listening would take you up on that.
Yes, Most people at Sprott, they would love to see significantly higher precious metals prices.
Yes.
I'm not saying this because I'm a board member of Sprott. I'm saying this because, for me, the difficulty is to understand that in this money printing environment, precious metals are not yet significantly higher. This is something I don't quite understand. Because let's say, if you look at all the wealth in the world, all the sovereign funds, all the pension funds and so forth, very few own any precious metals. But in my view, they should.
Exactly. And we're waiting for that to happen. Perhaps negative interest rates will help drive that too. That's a very good segue, actually, to another string of questions that we received, and it has to do with pension plans and the retirees that are either living off of pension income or expecting to, when so many pension plans are either underfunded or they're chasing returns by investing in risky assets. How do you think future monthly pension income will be affected when so few pension funds actually own good hedges and investments like precious metals?
Well, it's a good question, but you and I and nobody knows whether precious metals really will be the best performing asset. In theory, in a money printing environment, stocks could go up, and actually, as they have between 2011 and December 2015, stocks could outperform precious metals. But my view is that because of the manipulation I referred to by central banks answering the first question, because of that, we all don't know how the world will look like in 5 years. I cannot envision any scenario, and I repeat, any scenario under which there will not be significant pain for investors. Something will give at some point, and it will be very painful for asset holders. Exactly when and how it will happen, I don't know. People could continue to make a lot of money in assets like real estate, stocks, bonds, and precious metals, and one day the music stops and then losses will occur. But under this scenario, I would say a responsible investor who really thinks it through needs to be diversified. He needs to have some real estate, he needs to have some equities and bonds and cash, and obviously some precious metals. Each person is his own master, has to decide for himself how he wants to allocate it. I usually allocate roughly, as a guideline, 25% real estate, 25% equities, 25% precious metals, and 25%, say, bonds and cash. I think Eric Sprott would disagree with me, and he would have a much higher allocation to precious metals than I have. Equally, my friend who runs Nova Gold, he would also have a much larger allocation to precious metals than I have. And so forth. So, different people have different views. For me, to have about a 25% allocation to precious metals is probably much more than typical investors will have. You understand? Mm-hmm. So you're already overweight with that. Say, if you look at the S&P, what is the weight of precious metal shares in the S&P? It's very low. It's nowhere near 25%. So a fund manager, he will be reluctant to go to 25% because he's measured according to to a benchmark, which is, say, the S&P or the Russell 2000 or the Dow Jones or whatever it is. But I think that the pension funds, the whole industry stinks. As you said, they are grossly underfunded, but they don't tell the public that they're so underfunded. And they think that they can maintain their returns. The return expectations are around 7%. I think this is fantasy land in a world where, say, U.S. Treasury bonds The 10 years yields 1.78% tonight. The 30 years around 2.67% and so forth. So in that world, and zero interest rates, how are you going to make 7% per year in returns? It's out of the question. And then they go, as you said, in risky assets like private equity and so forth. But private equity depends on a buoyant stock market. So that the companies, the private equity firms, they buy assets, and then to make money, they will have to sell them to the public. In other words, they go and sell them into the share market. And that only works when the stock market is hot. It hasn't worked in the first quarter of this year when the markets performed poorly, so they couldn't sell. And so a lot of private equity firms will actually have large losses. Equally, as you know, hedge funds haven't performed well. So I think these return expectations are a mirage. And I would tell retirees, don't rely on your pensions. If they come, be pleasantly surprised and hope for the best, but I wouldn't rely entirely on it.
Yep, I think that most folks are starting to think of it that way. You're right. Just two more quick questions for you, Mark. One of them has to do with a gold standard. A lot of folks are talking about sound money and returning back to some type of sound money and a gold standard, but governments are already now so fiscally irresponsible. Why would a gold standard change their behavior? And then as a follow-up to that, do you think or even expect a government around the world, maybe the Chinese or the Russians or maybe a combination regionally, do you expect a return to some hard asset-backed currency as an alternative to the U.S. dollar?
The issue here is really, at the present time, and we have in the history of mankind, we had monarchies, and we had oligarchies, so we had all kinds of systems. At the present time, it seems that the world is ruled by a bunch of incompetent academics at central banks who can manipulate the entire global monetary system and with it asset prices and currencies. I think this regime will fail. Again, as I said earlier, I don't know when it will fail. It could fail in a year's time. It could fail in 5 years' time. But it's likely to completely fail. And when it fails, central bankers will have lost their prestige. People will be really fed up. Both the financial service industry and individual investors and actually responsible government officials, if they are such around. That is a big question, but if there are still some responsible people around, they will probably get rid of the power of central banks. And then they will scratch their heads and say, well, how could central banks get into a position of so much power? That will be then the question that will be asked. Then they'll find all kinds of documents that show how the central banks essentially manipulated markets and so on. So they will say, well, the best is to introduce some discipline. And the gold standard was not a perfect system, but it was a system that maintained some discipline until one country abandoned this discipline. And which country was it? Of course, the U.S. Because the U.S. has this American exceptionalism. For everybody a rule applies except for the U.S. And so they broke away essentially from the gold standard. And since then we have money printing, we have higher volatility in the economy, higher volatility in asset markets. And I believe that we will go back to some kind of a discipline system and hard currency system. But again, when it comes about, I don't know. And I also believe that when it happens, things will have to be very bad before it can happen, because as long as the central banks in the Western world, and I include Japan to that, those Western Europe, the US, Japan, as long as they can print, they'll do that. And probably the Chinese may also do it at some point. They also print money, but they have a more vibrant economy than other people have, although it may also go into recession now. So I think the mess will be such that, governments may sit together and say, well, we have to curtail the power of these central banks. The problem I have with this view is that if things really get bad, and before the whole system breaks down, certainly in the US, in Western Europe, they may introduce legislation, and they could introduce emergency legislation whereby they would say, you know why the economy is performing badly? It's because some people like Eric Strout and Mark Faber hold physical gold, and the money doesn't flow back into the economy. So the first thing that we need to do is to take the gold away from Eric Strout and Mark Faber and company. This is my concern.
Let's hope it doesn't come to that, but I know that's on a lot of folks' minds too. One last question for you, Mark, and it has to do with platinum, which historically is traded near the gold price, about the same, maybe within a couple of percentage points, but at present is down about 25% below the gold price. Why is that?
Trade at a premium.
Yes. Why is it now at a discount? Can you address that, and is that an opportunity?
Well, you ask me why. I should ask you. I don't know why. But I suppose that it's a less liquid type of market than the gold market, and it's more volatile. But historically seen, when the discount to the gold price was this high, platinum was a better buy than gold. So if someone is really keen to make capital gains, right now I think platinum and also silver are maybe more desirable than gold. I hold most of my precious metals in gold, but I have some platinum as well.
Yes, and I think a lot of folks are interested to hear your views on silver too. Yes, it hasn't quite kept up so far this year with gold, but do you like silver as well?
Yes, I think, let's put it this way, technically it looks very attractive and it could have a big move. But I believe that both platinum and silver are more perceived as industrials, or depending on industrial demand, than gold. Gold has not much, it has use in industry, but it's not perceived as being driven by industrial demand, whereas silver and platinum are to some extent driven by industrial demand. But I think that investors, again, because of what I said, that we don't know how the world will look like, that maybe they should also diversify out of gold and own some platinum and silver.
Sounds like it's always a good strategy. Dr. Faber, thank you so much for spending some time with us. It's brought money news.
My pleasure.
Can you just take one moment and tell everybody about the Gloom, Boom, and Doom report and how they can subscribe?
Well, I have two reports. One is the Gloom, Boom, and Doom report, which is a printed edition of a monthly report. And then I have a website report, the monthly report. And people who are interested, they can go to www.gloomboomdoom.com.
Thank you so much for your time.
Well,
joining us now is Mark Faber, editor and publisher of the Gloom, Boom, and Doom Report, website www.gloomboomdoom.com. Mark, we've done this so many times over the years, but I always ask you to start off. What are you seeing on your travels?
Well, basically, about 2 years ago, I started to see, certainly in Asia, a massive slowdown in economic activity. And this was reflected by the peak in commodity prices in 2011, and then more pronouncedly last July, August, when commodity prices really started to tumble. But there were also other signs of a slowdown. Industrial production was slowing down, and in many countries, the exchange rate started to weaken, which is not a sign of positive economic growth. And then we had these failed monetary policies by Japan and the ECB, and also to a large extent driven by the Fed, where because of the easing policies of the Fed, the euro and the yen had become very strong. Then the view was among the central planners who are academics at central banks, the view set in that the best would be to devalue the currency. So if you look at the world and you measure GDP in US dollars, if foreign central banks weaken their currencies, in dollar terms, world GDP declines and also global trade declines. And this is exactly what has happened. And at the same time, we saw in China after 2008 a gigantic credit bubble developing, and that obviously this credit bubble was not sustainable in the long run, that it would lead to a lot of misallocation of capital. And so the slowdown in the global economy was obvious already a long time ago. It wasn't acknowledged by the eternally bullish Wall Street fraternity and private bankers around the world who told their clients everything is fine. But it was quite obvious.
Mark, let me ask you this. What is the biggest danger in the financial system today as you see it?
Well, basically, there are many levels of danger. First of all, asset prices, whether it's for stocks, for bonds, for real estate, art, collectibles, wines, and so forth, asset prices are very elevated. In my view, they are at a very high level, especially if you compare the asset prices today, say, to the 1970s, when, because of sharply rising interest rates, asset prices, stocks, bonds, real estate were inexpensive. Now, all the asset prices are very high. Now, the Fed and other central banks' view was that by printing money, asset prices would go up, and that therefore there would be a trickle-down effect and boost economic activity. That was their view. Asset prices have gone up. In that sense, monetary policies have been successful to boost asset prices, but monetary policies have failed at boosting economic growth rates meaningfully. We had a very tepid recovery, a lack of capital spending, and the recovery has been largely driven by superimposing a debt bubble on another debt bubble. We had a credit bubble that led to the housing collapse in 2007, and then we had another credit bubble that is very pronounced, especially with regard to government debt. And government debt as a percent of the economy everywhere is up substantially.
You talked about the debt briefly there in the West and the fact that we went from one debt bubble superimposing another one on top of that, Mark. But, you know, people have watched this unfold in Japan for a long time, and the interest rates have stayed low there, and it just seems to go on until it stops working. And how close is the West to that point, Japan, the West itself?
Conditions, especially in the U.S., are quite different than in Japan. In Japan, you had not a large credit bubble and asset bubble, but by 1989, you had a huge stock market bubble and a huge real estate bubble. And then the asset bubble got deflated, but the standard of living of the average Japanese was not impaired, because whereas before he couldn't afford to join a golf club, he couldn't afford to buy a house or an apartment, and stocks were very expensive. Now the prices of real estate and of all consumer goods are more reasonable. But then came Abenomics, and by depressing the value of the yen, it makes Japanese in US dollar terms poorer. And so they actually, as a result of these Abenomics policies, they don't spend more. They rather spend less. So I would say, in general, the policies of central banks have been a complete failure, except for boosting asset prices. Now, the problem with asset prices is that they go up and they go down. And when asset prices decline, as they have in the last, say, 9 months, since May 2015 in the U.S. on the S&P, in emerging markets for the last 3 years, and in Japan more recently, and then the decline in stock prices since the beginning of the year. Even art prices in some cases are going down. Some luxury markets, real estate like Hamptons, New York, London, we also have some prices declining. It then has a negative impact on the economy. Now, the only way the central banks could actually counter this negative wealth impact on the economy would be to increase their money printing. In other words, the Fed would have to start QE4 and not implement it by, say, $85 billion a month, but say by $150 billion or $200 billion a month. Then we run into some problems. A, is it politically feasible? Maybe in election year not. And if the Republicans come in, maybe not. Or what they can also do is a mixture of monetary policies and fiscal policies, and that would be so-called helicopter money. You would send, say, each American family, either each one of them, or people that have a salary below a certain level, you would send them a check for, say, $10,000 US. And that would then boost economic activity temporarily in the short run, but actually probably less than is expected. So you understand, these interventions into the free market by the so-called neo-Keynesians have had some unintended consequences that are negative. And just before you asked me what is the biggest threat for the global economy, I would argue that following December 2008, when the Fed slashed interest rates to essentially zero, they stayed at zero essentially until December 2015, that is imprudent lending. In other words, the typical investor, he said to himself, if I put my money on deposit or treasury bills, I don't earn anything. So he went out on the yield curve, and treasuries have performed reasonably well, but he also went into junk bonds and into emerging market stocks. And that led in emerging economies to a huge capital spending binge, especially in China. So as a percent of global GDP, capital spending in emerging economies increased from 4% in 2005, 5% in 2007 to 8% recently. Now this capital spending is coming down, which is causing essentially this global recession I was just referring to.
Besides the money printing, which is a way to try to inflate out of this nightmare, should government theft be a big concern for investors going forward, Mark?
Yes, I think investors should be concerned that a bunch of academics and professors have so much power, and they basically have very little responsibility. You understand? If you say George Soros or Paul Tudor Jones or whoever it is in the hedge fund industry, you have your own money in the game. In other words, if you make bad decisions, you lose money as well. The central banks, basically, all the employees, their decisions can be hopelessly wrong, and they get hired by companies like Goldman Sachs and take huge salaries. So they have nothing to lose. And for them, the whole exercise is about power, and it's about trying new gimmicks as they move along. Like they are now more than $8 trillion worth of sovereign bonds with negative interest rates. Negative interest rates is a very interesting legal case, because in most constitutions it is written that expropriation is not an option. But negative interest rates are essentially an expropriation of savers' money.
Mark, obviously we've had this big rally in the gold market off the lows and seems to have tremendous strength underneath it. Your thoughts on what's going to happen here with gold?
Well, as you know, I always advocated that people own some gold, physical gold, and I always argued that a free market is a market where no market participant has an influence on the price. But nowadays, what actually is prohibited, and the criminal act in most countries, namely manipulation of markets, this is precisely being pursued by central banks. They manipulate currencies, they manipulate interest rates. And in this environment, you just don't know how far the mad professors will go. Looking forward, we all don't know how the world will look like in 5 years' time, 10 years' time. I would hold some real estate, I would hold some stocks, I would hold some bonds and cash and some precious metals. I happen to believe that the precious metals have probably bottomed out, so I cannot send you a guarantee for that. I don't know for sure. The mining stocks by historical standards compared to the price of gold and compared to the S&P 500 are incredibly depressed, even after most of them have almost doubled in price from the lows. The lows were in September, October of last year.
Mark, you bring up gold there exclusively for King World News listeners around the world who want to set up a gold account for yourself or a loved one. There is a 5% deposit bonus right now with BitGold up to $100, meaning you can put $2,000 into an account and instantly be credited with $2,100 of gold. To take advantage of that special offer, just email alexander@bitgold.com. That's ALEXANDER at bitgold.com. BitGold is revolutionizing the world, and you can become part of that revolution by opening your account today at bitgold.com. What do you expect, Mark, or what would be some predictions for the rest of 2016? Any surprises out there?
Well, I believe the stock markets around the world will end the year lower, but it will depend on how much money the central bankers will print. As I said, you don't know how far these mad professors will go. They can launch a QE4 with $500 billion a month, and in theory, they could buy the whole stock market. Well, some central banks.
Today we are pleased to have Mr. Marc Faber as our guest. Mr. Faber has agreed to be our guest today to discuss the stability. Hopefully we'll discuss the stability of the world's financial situation. Hopefully it's a lot more stable than the problems that we've had this morning with our board operation. But Mr. Faber is a Swiss investor based in Thailand and publisher of the Gloom, Boom, and Doom report, and is the director of Marc Faber Limited, which acts as an investment advisor and fund manager. He can be reached on through his website, gloomboomanddoom.com. His worldview and scope of knowledge is second to none, and he'll be asked today about the risk of global collapse in the bond market. If you wish, you may call in with your questions or comments, 646-652-4620. Make sure you press the 1 button so we know that you want to interfere with the program and ask your question. Mr. Faber, thank you so much for being on our show today.
It's my pleasure. Thank you.
Well, you know, I have to admit that I'm a real fan of yours. I probably listen to you about once a week, you know, online, and I truly enjoy your insights. Not long ago, I had Michael Pinto on, and of course, he's big in the bond market, and he's written a book about the upcoming bond collapse, which he wrote back in 2003. And also, Gerald Celente, he's not too happy about what's going on as well. And I was wondering what your take was. It seems that the world is enveloped in debt. And the way we're going to get out of the malaise, the international malaise that we are in financially, is creating more debt, lower interest rates, and printing more money. Now, I'm not the smartest guy in the world. I'll be the first to admit it. But it sure seems like this is lunatics running the asylum. Am I way off base, or should I just find another profession at this point?
No, I've maintained that for a long time, that you cannot trust the monetary system to a bunch of academics, most of whom never worked in their lives except in academia and at government agencies such as the Federal Reserve and other central banks in the world. And there's no question that it will end badly. This unprecedented monetary experiment. Here we have recorded human history of something like 5,000–6,000 years, and interest rates have never been this low. We never had negative interest rates, and it is clear one day the bond market will react negatively. But it's not so crystal clear how it will manifest itself. Because in theory, if you think about it, in Japan, the Bank of Japan is essentially buying all the debts that are being issued by the Japanese Treasury. So that keeps rates very low. The question is, what will first happen? A collapse in the currency? And if there is a collapse in the currency, against what will the currency collapse? You know, you could argue, some will argue, well, the yen will collapse against the US dollar, or the euro will collapse against the US dollar, and others will say, well, the US dollar will collapse against the yen and against the euro. We don't know for sure, but my sense is that currencies will continue to lose their purchasing power. And if you recall, I mean, you're not that young anymore. So you also lived through the 70s and the early 80s when people were all concerned about accelerating inflation. And now the slogan is always deflation. But actually, in fact, if you look at home prices in the US, if you look at stock prices, if you look at art prices, at vintage cars, if you look at your insurance premiums, and if you look at the educational costs for your children, and taxes and contributions to the government, everything has become massively more expensive. So I don't see any evidence of serious deflation where the price level, like in the Depression years, dropped 30%. That hasn't happened. Some prices have gone down. So say someone will say, well, the price of a PC or a notebook or a mobile phone has gone down. But that is, again, depends on what model you buy. The models of computer I use, actually their prices have gone up. Now someone will come and say that the functionality of the computer you have is much better today than it was 5 years ago. That's correct. but I also need a much better computer now to function in business than I needed at that time. Right. It's like 15 or 20 years ago. I didn't need the internet. We had faxes and telex machines and so forth. So it changes everything. But in general, I would say the cost of living of people has gone up a lot. And that's why you see a relatively poor economy. Most people have not benefited from the asset bubble because they have no money. It's as simple as that.
Yeah.
And of course it will end badly. Socialism does not bring poverty. It is poverty that brings socialism. When people are disenchanted, when people are unhappy about the system, and Donald Trump and Bernie Sanders are symptoms of a very unhappy population. Otherwise, they wouldn't have gone this far.
Right.
There is but this is not only in the U.S. In democracies in general, there is a complete disconnect between the will of the people, between the people and the government officials. And I think if most people understood what the Fed is doing, they would be against it. As it happens, most people don't understand what the Fed is all about. They're more interested in Facebook pictures that only they look at and nobody else. But basically, it is a travesty, the way central bankers are behaving and destroying the value of money. And you have to also see there is credit growth that is useful. You talked earlier on about this debt bubble in the world. There is credit that is useful. Say you and I, we build a factory, we borrow money to build the factory, to buy the land, to acquire the machinery, to employ the employees, and to acquire inventories, and we start producing. Out of the production, we can then cover the interest payments and repay the debt. But our debt growth in the last 20, 30 years in the world has been debts that are unproductive, namely government debt, transfer payments. In other words, you take money out of your pocket and you give it to somebody else's pocket. Has no economic value at all. And so I think you're right, it will end very badly. But if you ask me exactly how badly and when it will end badly, I don't know. My sense is that one way to protect yourself is through diversification. It's dangerous to have all your money in cash in a bank. That has to be understood. In an environment where central banks are destroying the value of money, it's dangerous to have only cash. So I would have some real estate with low leverage, and I would have maybe some equities. I have equities, and I would have some precious metals. And I would essentially avoid government bonds that have a negative yield. You understand? Nowadays in the world, you have $8 trillion worth of bonds with a negative yield.
Right.
In other words, you're guaranteed to lose money. Maybe not that much, but you're guaranteed to lose some money.
Right. Well,
since I'm such a great optimist, I think I can make some money.
Well, I guess, I just keep on going back to, my earlier years, and I'm still very young. I'm only 73, but I'm gonna make it somehow.
Okay.
And but my times was so different when I was building up businesses, and I've done a few of those. And mine is that you saved money, you invested it, you purchased items that were producible, that produced income, you stayed out of debt. I mean, basically, everything that I've learned, everything that I have done to become, to be where I am today, I own this whole studio, and I do it for fun. I mean, can you imagine someone saying, oh, yeah, I'm going to open up a studio just for fun? But this is what I do. This is one of the things that I do. It's some people,
America has to be grateful to people like you.
Thank you so much. I appreciate those words from you especially. But
yes.
What bothers me is that the whole world seems to be contrary to the way I have built businesses and the way I have grown up. And what really surprises me is that the bastion of solid currency, your homeland of Switzerland, is that not right? You're from you're from Switzerland, has the highest negative interest rates in Europe, I believe. And you would think if there would be one country standing up and saying, "No, this is wrong," it would be the Swiss, and they didn't do that. Is it a worldwide conspiracy? They all can't be on the same page at the same time doing the same idiotic thing. What's your take on that?
I want to tell you, some people have talked about currency wars. There is no currency war, except there is coordination among central banks. They talk to each other daily, every day. The Bank of England, the Federal Reserve, the ECB, the Bank of Japan, they coordinate the monetary policy. So for a while, say the Fed eases, QE1, QE2, then Operation Twist, QE3, then they say to the Japanese, well, you know, you better do something as well because your yen is too strong. Yeah. So you have to bring the value down of the yen. So then they embark, and then the ECB embarks. And the problem for small countries like Switzerland is then, if they don't play the game, their currency appreciates very substantially. Now, don't misunderstand me. I personally, as an economist, I don't think that the strong currency is damaging your industry.
Right.
That's all BS, essentially broadcasted by entrepreneurs and industry. They always say, oh, the currency is too strong, we can't compete. The countries with the strongest currencies over longer periods of time, like Germany, Japan, Switzerland, they are the strongest exporting countries.
Right.
And countries that have weak currencies over a longer period of time, like Latin America, they have very weak industry. They have resources, but their industries are relatively weak. Strong currencies forces the entrepreneurs to become more and more productive. So, but in Switzerland, the view was then among politicians and so forth that they can't compete if the currency is strong. So they have to take measures to lower the value of their currency, which to some extent they managed to do. But it has no positive impact on Switzerland. You understand? It's like in Japan, a weak yen hasn't been positive at all for the economy. In fact, it's been negative, say, you're a Japanese, you have your assets in yen. So 2 years ago, your assets in yen could be exchanged into US dollars at a 30% higher value. If you look at Japan, you measure the GDP in yen. In dollar terms, GDP is down 30% now. In dollar terms.
Right.
So you understand, these devaluations are far from certain to be beneficial at all. But my sense is that all currencies will eventually continue to weaken, and they'll probably weaken against monetary assets like gold, silver, and platinum.
Well, you know, I took some basic economic courses when I went to college, and I went to a very good college. It was Pace College at the time in downtown New York, is in Wall Street area. And it was a very popular college for people who wanted to go into marketing or finance. And I don't recall one page of economic theory that talked about the benefits of negative interest rates. Where did these clowns get this idea from?
Yes, you said it. They're clowns.
Thank you.
Well, I want to tell you, the idea is basically that if you have excessive debts, you want to reduce the burden on the people that have the debts. But there are many unintended consequences for the system. Let's say in America or throughout the world, a lot of people have savings. You could be in retirement, so you would have savings, you would have some income from the interest on your savings, and you would have your pension, and you would have Social Security or whatnot. Now, the people that have savings, they don't get anything.
Right.
In some countries, they're penalized. And number two, you see, the Fed and other central banks, they brainwashed the world in kind of telling them deflation is bad and inflation is good.
Right.
This is utter economic nonsense because, in the 19th century in the US, we had 100 years basically of price stability with intermediate periods of deflation. Right. But what happened is that the real wages went up. In other words, wages were stable or rising, and the cost of transportation, the cost of living went down. And so people became richer. In other words, GDP per capita in real terms in the 19th century increased at a faster pace than after the Federal Reserve was formed. So it was not a system where deflation was negative. Deflation has some negative aspects when you are over-leveraged. But this is not the problem of deflation. It's the problem that the central bankers, the clowns, you call them so appropriately, they were sleeping on the wheel during the huge debt bubble they created at the end of the 1990s and then until 2007. And now they're creating an even greater debt bubble, but this time it's largely government debt. That is the least productive debt.
Yeah. Well, we've been through now. This is the third major bubble in 15 years or so.
Yes.
You know, we've had the dot-com bubble, the tech bubble. We've had the housing bubble, and now we have a debt bubble or a bond bubble, and this one trumps the other two significantly. Now, we didn't solve the problem. In other words, the patient was dying back in 1998. Remember long-term capital management, that blew up. Jim Rickards, who was the lead counsel at the time, had to negotiate with Greenspan et al. In order to save the entire world from collapsing. Well, that is minuscule compared to what is occurring today. I just wonder what these people are thinking of. They know it's not going to last. And what are they doing to prepare for the big one?
Yes, they don't do anything. They just think. One of these central bankers said the other day, we are magic people. You understand?
Yeah.
It's not only that they're incompetent, but they're also arrogant. That is the problem. Number two, I mean, you raised the issue of LTCM, long-term capital. For the system, it would have been best if they had failed.
Right.
Because that was a time when it's not yet too big to fail. And then again, the NASDAQ bubble, it would have been better to let it deflate further and let the system be cleaned out instead of, as the neo-Keynesian all wanted, to create another bubble. But you understand, you're dealing with the fund management industry and Wall Street. They love bubbles.
Right.
Because their fees are paid on net asset value. The worst for them is that actually asset prices decline, then they get less fees. So they encourage, actually, it's kind of a symbiotic relationship between the Goldman Sachses of this world. I'm not singling out Goldman Sachs, although maybe one should, and The central banks. The central banks, they will coordinate with the Wall Street people and so forth what to do. And when a central banker retires, he gets an advisory job with one of the Wall Street firms that pays a few $1 million a year. Not my problem. I'm happy for them. I'm just saying it's basically a mafia that is not run by professional gangsters, but by clowns. As you said.
Okay. Thank you.
Yes.
Well, you know, I usually give people who are not in tune with the economics or the financial condition, the average Joe Blow who needs things simplified. I say, well, just consider 1998, the patient got very sick. And the doctors knew what type of medicine would be necessary in order to save the patient, but they decided that would be too much work. They just gave him a lot of morphine, and he felt really good. So he popped out of bed, and he's running around with all this morphine, and then the morphine wore off. And then he got really very, very sick and hardly walk, but they pumped him up with a whole bunch of morphine again. He got up and he was able to at least walk around with a cane, but he can walk around, and he felt pretty good about it. Well, now the patient is sick again, and the morphine ain't going to work. So how do you see what do you see is how this thing is going to unravel? I see nothing but, I hate to be melodramatic, but it seems like almost Armageddon, financial Armageddon is before us, and we're facing it in.
Yeah, I basically agree with you, but you understand, if you print money, in theory, you can boost the Dow Jones to 100,000 within 2 years.
Right.
You just have to print enough.
Right.
And you can boost the Japanese market. You just print enough. Where I have some hesitation to believe that entirely is I see some signs of inflation rising. You understand? At some point, the money printing may not go into stocks and into bonds and into art, where it may go into rising consumer prices. And then what happens, and this has, because I studied the process of high inflation countries or inflation in countries with high inflation. What happens is that, and this has happened in the US and in Europe, real wages go down. In other words,
right.
The cost of living of people is going up more than their wages. So the standards of living is declining. But when that happens, what usually then occurs is that the economy worsens significantly. Then the clowns at the central banks will say, well, and they will be supported by the likes of Krugman, well, we need more. We didn't do enough.
Right.
Then they'll throw again money at the system. QE4, QE5, QE6. And that can go on for quite some time. You understand? The central bank can keep on buying the bonds that the Treasury is issuing. I don't know how it will end. But I suppose that in this situation, people and investors will lose confidence in the system, and they will want to own precious metals or some properties. Now, some properties are too expensive, but some properties around the world in the countryside are not that expensive. You live in Tulsa, well, maybe in prime location it's expensive, it's like Phoenix, but in other locations maybe not that expensive.
That's correct. Well, people want to blame all of the people who have money. And of course, they categorize everyone into one group. Of course, there are those people within the system that are cheating the system, that are connected with government, with industry, that have some sort of allegiance to individuals that they support for government, for office, and as a result, they get kickbacks and all that funny money and all that dirty stuff that goes on. But for the most part, there are people who adhere to basic valid economic principles. like, you produce, you invest, you save, and this cycle, which are very few. I believe, and tell me if I'm wrong, those people who are adhering to the old paradigm of hard work, honest living, saving, and doing the right thing, basically, economically and personally, these people are going to do extremely well because they're always prepared for catastrophe, because that's the way they live. They always make sure that there's money on the side, that the money is allocated in a certain way, and that their business are productive and out of debt. Now, but these people are not the mega rich. These are those people who are doing well because they adhere to principles of economics that are valid. Do you agree with that?
Yes, of course. I mean, as is the case for you, you see, my parents, they had lived through World War II,
right,
and my grandparents, they had lived through World War I and the Depression years, and in Germany, the hyperinflation years. They had one disaster after another,
right,
in the 20th century. So after World War II, they were, of course, financially extremely conservative.
Right.
In my family, nobody ever borrowed any money. When they saved, when they had enough savings, they bought a car or whatever it is. They would never have dreamt to buy anything on installment credit, nor would I. But this has changed, this mentality, and also the whole entitlement mentality. Each time something happens, the government should help me. Well, you want freedom, you have to accept personal responsibility. If you're not prepared to have your personal responsibility, then you should go and live in a socialist country.
Yeah, like the United States.
That is now creeping in Europe and in the US.
Yeah, but aren't we a socialist country now? I mean, for all intent and purposes, the money is absconded from the productive and then divvied out to political favors. And for those people who are producing nothing, government, although is not growing anymore, but people who work for the government are in fact not producing anything and shouldn't even be included in the employment statistics.
I agree with you. I don't think that government spending should be included in GDP.
Right. It should be deducted.
But you understand, I also believe we don't have a socialist system the way we had it in the Soviet Union and in China and Vietnam and in Eastern Europe following the Second World War, or in Russia since 1918. But we have maybe a worse combination. We have crony capitalism, as you just hinted before, unless a large businessman